Apple's shareholders' equity. This is the third video in a series which investigates and describes all aspects of the financial statement with Apple as a leading example. The video consists of three main parts concerning the shareholders' equity: common stock and additional paid-in capital, retained earnings or accumulated deficit, and accumulated other comprehensive income or loss. The beginning balance of 2022 amounted to roughly $63 billion. This sum is the same as the ending balance of 2021. For a more detailed examination of the additional paid-in capital and some other basic terms not mentioned in this video, have a look at the first and second video concerning the income statement and balance sheet first. Common stock issued. Common stock issued is a means the company can use to bring in more cash to the business by giving up or diluting some of the ownership. For example, Apple stocks representing a part of the company can be brought to a marketplace to be sold. The marketplace, which in this case is the Nasdaq, functions as a trading place between sellers and buyers. If Apple represents the sellers, the investors will be the buyers. The investors give up their cash in return for Apple stocks, with the hope of gaining a reward for the investment larger than if the cash were put elsewhere. The second row in Apple's shareholders' equity consists of common stock withheld related to net share settlement of equity awards. Common stock withheld related to net share settlement of equity awards refers to the shares of common stock that are withheld by the company to pay for the exercise price or tax withholding obligations that arise from the settlement of equity awards. This can include stock options, restricted stock units, RSUs, and other forms of equity compensation. When common stock is withheld to pay for these obligations, it can be accounted for either under common stock and additional paid-in capital or retained earnings or accumulated deficit. The choice of how to account for the common stock withheld depends on the accounting rules and conventions that apply to the company. Suppose the common stock is accounted for under common stock and additional paid-in capital. In that case, it means that the company is treating the common stock as a reduction in the amount of additional paid-in capital that was created when the stock was originally issued. This treatment reflects the fact that the company is using a portion of the capital that was contributed by the stockholders to pay for the settlement of the equity awards. Share-based compensation is the last row to examine in the first part. The value of the shares used for the share-based compensation is measured as the closing price of common stocks due to the date when the granting of the awards is authorized. A popular share-based compensation is to reward employees with ownership in the business and give them shares as a company benefit. As of September 24th, 2022, the total undetermined compensation expense associated with outstanding RSUs and stock options amounted to $16.7 billion, and the company anticipates recognizing this over an average weighted duration of 2.6 years. The next part, retained earnings or accumulated deficit, contains the beginning balance from the ending balance of 2021, net income and dividend equivalents declared to begin with. Dividends and dividend equivalents declared represents the distributions of a company's earnings to its shareholders and the corresponding payments made to holders of certain types of financial instruments that are tied to the company's stock. Dividend equivalents are payments made to holders of financial instruments, such as restricted stock units, RSUs, or stock options, which mimic the value of dividends paid to the company's shareholders. These payments allow to the holders of such instruments to benefit from the company's dividend distributions, even though they do not directly own the underlying shares of stock. If the common stock is accounted for under retained earnings or accumulated deficit, it means that the company is treating the common stock as a reduction in its retained earnings or an increase in its accumulated deficit, depending on whether the company has a positive or negative retained earnings at the time of the settlement. This treatment reflects the fact that the company is using a portion of its earnings to pay for the settlement of equity awards. The next row, common stock repurchased, amounted to a staggering $90 billion. Common stock repurchased, also known as a share buyback, is a process in which a company buys back its shares from the market, reducing the number of outstanding shares. This can be done for various reasons, such as increasing the value of remaining shares, improving financial ratios, or consolidated ownership. Let's say that Apple decides to repurchase some of its shares. Apple would allocate a certain amount of money for this purpose and start buying its shares from the open market. When Apple repurchases its shares, it pays investors the market price for each share. The investors receive the money and, in return, Apple gets back the stock shares. Once the shares are repurchased, Apple can either retire them, which means they are permanently removed from circulation, or keep them as a treasury stock to be reissued later for various purposes, such as employee compensation or funding acquisitions. By repurchasing its shares, Apple reduces the number of outstanding shares in the market, which often leads to an increase in the stock's price due to the dynamics of supply and demand. This can benefit the remaining shareholders, as their shares may become more valuable. Additionally, the reduced share count can improve financial ratios such as earnings per share (EPS), making the company appear more attractive to investors. The last row in the second part of Apple's shareholders' equity represents the cumulative effect of change in accounting principle. The cumulative effect of change in accounting principle refers to the impact that a change in accounting method has on the financial statement of a company in the current and future periods. The cumulative effect of a change in accounting principle is calculated as the difference between the previous accounting method and the new method applied retrospectively to all prior periods. This amount is then reported as an adjustment to the beginning balance of retained earnings in the current period. For example, if a company changes its method of recognizing revenue from the cash basis to the accrual basis, the cumulative effect of this change will be the difference between the revenue that was recognized under the old method and the revenue that would have been recognized under the new method in prior periods. This difference would then be reported as an adjustment to the beginning balance of retained earnings in the current period. The final part to look into is accumulated other comprehensive income or loss. Other comprehensive income or loss, or OCI, is a component of shareholders' equity that represent unrealized gains or losses on certain financial assets, as well as certain other items that are not included in the net income of a company. Here are 3 examples of items that can affect the category. 1. Unrealized gains or losses on available for sale securities. Available for sale securities are investments that are not held for trading purposes and are not intended to be held to maturity. Any unrealized gains or losses on these investments are recognized in OCI until they are sold, at which point they are included in the net income of the company. 2. Foreign currency translation adjustments. If a company has subsidiaries or operations located in foreign countries, it may need to translate the financial statements of those entities into the reporting currency of the parent company. Any gains or losses resulting from changes in foreign currency exchange rates are recognized in OCI. Third, pension plan adjustments. Many companies offer defined benefit pension plans to their employees, which promise to pay out a certain level of benefits based on years of service and salary. The present value of the future pension payments is recognized on the balance sheet, and any gains or losses resulting from changes in the assumptions used to calculate the current value are recognized in OCI. By summing up the ending balance of all three parts related to Apple's shareholders' equity of 2022, a total shareholders' equity ending balances of roughly $50 billion can be established. Ultimately, the final row of dividends and dividend equivalents declared per share or RSU indicates a value of $0.9. This was the third part of a series examining and explaining the financial statement with Apple as a leading example. For more videos, please subscribe. If you like this video, make sure to check out the next one. Thank you.